So, as I said, that today's topic is achieving financial freedom through infinite banking strategy. That's mouthful. That's a lot of words there, which sounds too fancy. But as you see at the end of the session, if you understand this, you basically understand the how money works, basically, right? So let me show you a few of the concepts and kind of break this down. So what is financial freedom? Right? If I ask this questions, say right now we have how many people on this one? We have about 21 people. If I ask this question, what is financial uh, freedom? I will get 21 different answers, right? Somebody will say retirement, somebody will say something. To me, like most of the people you see, in the financial world, they say financial freedom means, as you can, you go to many seminars and webinars, they show you their, uh, $5 million house, big like 10-acre land, big yacht, and beautiful wife, beautiful kids, vacations, and jewelry. That's how they show you as a financial freedom. In my, to keep it simple, that is good. Like, but that is not the only financial freedom we are looking for. What is financial freedom is that you are financially free. No rocket science, right? And what does that mean? Let's say you are 50, you are, and let's say you want to be financial free, at least free on 50. That means from 51 onwards, you're working for fun, you're working for some other reasons, but the money is not a reason you're working, right? Money is not a reason which is a high priority in your life. You have a bigger goals in your life, right? So financial freedom is more like, as I said, while you are working for money up to certain age, but at some point money starts working for you. The day money starts working for you, that is financial freedom. That doesn't mean nobody's working. Somebody's working in your house, but you or your wife or your husband, you guys are not working. You have your money working. So when your money is producing more income than what you're spending, that is called financial freedom. In my opinion, in that is something we all should achieve. Now, yes, if you get this, at a certain age, we call it retirement. But again, retirement doesn't mean you retire from work, you retire from worrying about finance. Okay, and then we talked about infinite banking. Before I say infinite banking, let's understand what banking is. What is a bank? Again, very simple. You go to a bank, what are we doing? We're depositing the fund in the bank and we're getting interest on the fund. And then bank is lending that money to somebody else, and bank is then uh, getting the interest. So the borrowing interest is higher for like the money which is bank is lending has higher interest than the money they're borrowing, right? And that's why they have a positive arbitrage. So they are giving us 5% interest, whereas customer or consumer is giving them 7. So they make that 2%. That's called banking for them, right? Infinite banking. What is infinite banking? And again, this is a, if you Google it, this word is really, really like have a lot of misconception, especially whole life insurance people have decided to use this for something else. But I'll tell you, this is beyond whole life, or this is beyond. Infinite bank means you have a bank where you are borrowing at a lower percentage and you are earning at a higher percentage, and you never pay money to bank. Neither you pay the interest, neither you pay the principal, and you are the bank. So basically, you become your own bank. So now, if you Google the word "be your own bank," infinite bank, that is the actual concept. But what happened a few years ago? Somebody wrote a book, and there was a whole life insurance agent, and they said, "Oh, this is so whole life is not infinite bank. Infinite bank means you are borrowing at a lower rate, you are investing at a higher rate, and you never pay the interest, never pay the principal back, and you are your own bank. Those are the 5 things becomes infinite bank. Basically, you become your own bank. Why would you not do it, right? So if you have a positive arbitrage, right? If you get 2% interest on the plus on top of what you have borrowed, why would we not be doing that? I mean, you see how many banks are there. Why can't we become our own bank? Now this is just a concept, right? It's still like, we all are having full-time jobs and all that. So how do we do this? We don't have to think about doing banking. It should be part of your day-to-day investments. It should become your day-to-day. So when you are, for example, when you're doing college funding, use infinite banking concept to do college funding. When you're doing retirement funding, which is your 401k or IRA, use infinite banking concept there. When you're buying a house, mortgage, use infinite banking concept there. And when you're doing investments, like a lot of people are maybe a business people, right? Now I have a lot of friends who do real estate, like they like to buy houses every few years. Use infinite banking, right? So again, infinite banking is a kind of it's a bigger umbrella of, there's a word called OPM, which is a use other people's money, right? So in this case, you're using other people's money, using positive arbitrage. Technically speaking, you're not using other people's money, you're using your own money, your own bag. Okay, so then let me now go into a little bit detail. So one thing to break it further down, we have to understand what is the difference between compounding and amortization. And again, I will not explain the concept. I'll actually show an example, right? So I'm going to open it for chat. Please, everybody participate. I was supposed to have the poll, but I ran out of time. So I'm going to give you three deals. And I want you guys to tell me in the priority, which is a good deal or bad deal, okay? So deal number one, everybody pay attention, please. Borrow at 6%. So you're borrowing at 6% from wherever, right? Again, this is nothing has to do with infinite bank. It's just a simple borrowing and investing concept. You borrow at 6%, you're investing at 6%. Is it a good deal, bad deal, or no deal? Okay. Is it you borrow at 6% and you invest at 3%. So basically, you're investing only at 3%, you're paying more on 6%. And then the third deal is you borrow at 3% and invest at 6%. So if you can start, if you all can start typing in the chat, according to you, which one is a good deal, which one is a bad deal, which one is a no deal. I see some people already started doing that. That's good. 1 and 2 are bad, 3 is good. Okay. So 1 is bad, deal 3 is good, Chetan bhai. Okay, Geeta Ben, you said 1, 2, 3. Okay, Ramesh. Upendra, 1 and 2 bad. Okay, 3 is good deal. Okay, perfect. Okay, perfect. 3 is good deal. Okay. Does anybody think this all 3 are good deals? And I know some people are still typing, so I don't see anybody has typed that all 3 are good deals. So let me show it to you. I say all 3 are good deals. And let me prove it to you guys. Okay. So ready? So as I said, this is going to be a good session. If you understand this, this is how the rich people work, right? So again, we already said this, most of you said, okay deal or no deal, right? No deal. This is really a bad deal, and this is really a good deal, right? Most of you said that. Even I used to say this after learning. So now let's look at the loan versus investment. So on the left side, I have loan. Okay, so I'm borrowing at 3%, sorry, 6%. Investing at 6%. Okay, deal number one. Remember? So deal number is borrow at 6, invest at 6. And I'm doing this Excel, so you guys can do the same thing. If anybody needs, just reach out to me. I'll send Excel also. You can play with this. So here I'm taking $100,000 loan at 6%, and I will pay in 30 years. And I will do amortization, and I'll show you what amortization. And then same money I'm actually investing in. So I'm not using my money. I borrowed 100,000 at 6%, investing at same 100,000 at 6%. Now here's the magic. You see 100,000. If you see here, I have to pay how much? So this is a amortization formula, right? So you can also look for Google amortization schedule. You'll see this, right? So basically every year I have to pay 7,265. If I keep paying that, in 30 years, my loan will become zero. Out of which 7,265, if you see certain portion goes towards principal and some goes towards interest. For those people who have mortgage, you must know how this works, or car loan. This is how the amortization works. So in this case, I pay principal 1,265, pay the interest 6,000. That is 6%. What happened next year? because I paid little bit of principal, my interest had gone down. The interest rate is same, but because my principal went down, my interest dollar went down. And likewise, if you see every year, my interest keeps going down. So if you now see in 30 years, I had paid how much interest I paid? 117,000 I paid, because so I borrowed $100,000 and to pay that 100,000, I paid so much interest. You see this horrible, right? That's 117,000. So my total money outflow was 227. Anyway, so this is how much I paid as an interest, my cost. But one thing I'm showing you, the interest is decreasing. Now I'm actually investing the same 100,000 into some secure asset, 6%, right? If you see here, first year I got 6,000, but now because I'm compounding, that 6,000 was added in my capital. So my principal went up, and now at the next year, the interest rate went up. So now if you see the interest is keep going up, it's a 6%, but it's compounding. It's compounding interest, getting interest on top of interest. So if you see the same 30 years, I made 474 in the interest alone. So what is the net I made? My net profit was 356. So when we said those people, again, it was a trick question. So those people who said deal number one is not a good deal or a bad deal or no deal at all, that's $300,000. That's a good deal, right? Let's look at the deal number two. We're still borrowing at 6 and investing at 3. You get the concept. It is still a good deal because my net profit out of that deal is 24,000. A lot of people buy houses. Let's say they do $500,000. Okay, and if you understand this concept, that's $123,000. That's not a small amount, right? So again, even the second one was a good deal, even though it sounded horrible. And obviously, if you have 6% and 6%, I mean, no, not 6%. This was 3%. Deal number 3%. This was 6%. Obviously, it's going to win anyway because that was straightforward, 400. So as you can see, even you're borrowing at double the rate and you're investing at half the rate of that, it is still a good deal, right? That's how it works. Now, what happens again? Let me go back to 6 and 6. So here's the comparison of the interest, right? So if you see the red one is interest dollar in the amortization, and it keeps going down. In the gray one is the actual interest in the compounding, which keeps going up. This is the concept of positive arbitrage. This is called, even though we have no positive, even if I have negative positive arbitrage, borrowing at 6, investing at 3, that is a negative arbitrage. That is a negative. It still works crazy. I mean, let's say in this case, we say it's 24,000. It's not a lot, but it is not a bad deal, to be very honest. So this is the concept of the
మీకు
banking we're going to apply to all the investors. Somebody has a question?
ఈరోజు ఎవరు లేకుండే లక్కీగా ఉంటుంటే మంచిగా ఉంటుంది.
I said, you have a question?
Hey, sorry, Andy, I forgot to mute it.
No worries. All right. So with that said, thanks to Sid. Anybody else has questions? Okay. So this is clear now, right? I didn't mean to. I'm not trying to offend anybody, but it was a best way for me to demonstrate that all are good deal. That doesn't mean you guys are all wrong and I'm right. That's not the intent. As you can see that how when I saw this first time, I'm a Gujarati background. Money is I've been doing stock market trading since I was in 12th grade. And when I saw this first time, you can't imagine what I went through. I lost my sleep that night. I was thinking, how come I did not never thought this way? So if you see this, right, deal number one gave us a net profit of 356. Deal number two sounded so horrible, still positive. Anything positive is good. And deal number three is a no-brainer, right? So the question is why then if this is the thing, if this is the concept now you understand, right? Why do all do this all the time? Why we just do this and not worry about anything else? Why can't we use this in retirement funding or college funding or mortgage funding, right? Why are we not doing this? So the core reasons, which I have many people I've talked to, some of the concepts they don't it sounds good, but they don't implement it. And many, first of all, have the lack of knowledge. They don't even know that this is how the money works. This is how even the negative arbitrage can be positive if you work, you can deploy the cash correctly, right? So A is that lack of knowledge, and that's why we are here. That's what Murli and I talked about. It's good for you all to learn that. But I think most of the people don't do it because there's a lack of compounding vehicles. If I ask you this, hey guys, let's do this. Let's borrow at 6 and invest at 6. Most of you will struggle where to invest, right? I mean, bank CDs, okay, it's giving 5% right now, but bank CDs don't give 6%. What about bonds? Bonds are okay, but as the Fed has meetings every 3 months and bond market also fluctuates, so there's a risk element. What about real estate? Real estate is also good, but then real estate is also shaky, right? Those people who were burnt in 2008 never want to talk about real estate. What about stock market? Everybody's favorite, right? That has to be the best answer, right? Stock market also, does everybody go and invest and make 6%? I mean, look at last 2, 3, 4 years, or even 20 years, a lot of people have lost ton of money. And I'm not saying it's bad investment vehicle, but I'm just saying there's a risk. So there's a risk of the market loss. The risk and the fear does not allow us to go all the way in. I would not borrow at 6% from a bank and then buy stocks because I had that fear. Even though stock market is amazing, and then on top of that, I had to pay taxes for all the gain I make, right? So what if I borrow at 6%, invest at 6%, and then what if the 20% goes into taxes? So now that formula doesn't work. Then now my calculation messed up, right? So because of this, people are not doing it. Those even who knows it don't do it. So how about if we eliminate this? How about if we say, you know what, let's find a vehicle which can eliminate all of this. So for example, here, let's look at this core principles. This is what wealthy people do. Like, core 4 major principles. Maximize your growth. Basically, beat the inflation and taxes, get the high rate of return possible, grow your money compound. The best possible way. Like 7%, 6%, 10%, right? Grow this. And where do you grow this? Usually most of people do it in stock market. If you look at your 401ks, 529, IRA, all stock market, and we will also try to do the same. But at the same time, do not lose that penny. Do not lose your principal and do not lose the interest you have made. So then you have to protect that asset also, right? And then make sure your taxes are in right order. You as much as possible, you make the taxes free. Like your gain should be free, and then asset should be protected. So these are the 4 diversification wealth building principles. We need to apply this. If we apply this, then the fear goes away. Then we are taking care of all these solves. We are compounding, we are securing, we are no longer paying taxes, and obviously we will do this. So we'll have education. The idea is we will then. So when I say this, borrow at 6 and invest at 6, what if the investment is losing money? Then this formula will not work. And we are going to remove all of the risk from the investment. So now borrowing is guaranteed, investment is guaranteed. And if both are guaranteed or secured, then you're fine. Then these formulas will work. So not only we have to understand this, but we also have to find those vehicles which are safer in the investment area. Okay. Now, when I say borrow means don't borrow from the bank. In this case, we're going to show you how to borrow from your own fund so it becomes infinite banking. Okay, so going further, just quickly, those people are joining new. I just want to take few seconds on each one of them. So how do you maximize the growth? Basically, there's a rule of 72. If you invest, say, if you invest 100,000, say you are 29, invest 100,000 at 2%. Basically, rule of 72 says you take 72 divide by rate of return. It will tell you how many years it takes to double your money. So 72 divided by 2, 36 years. So if you invested 100,000, it become 200,000 after 36 years. If you invest the same at 4%, it will become 400,000. So 100 became 200 here, 100 became 400 here. But when you invest the same money at 8%, that 100,000 is not 800. So for example, it became 400 here. It is not 800, it's 1.6. So that's the power of compounding. If you go above 6%, the compounding will work much faster. So when you do 8%, your money is doubling every 9 years. Now the question is, where do you do this? And again, I said stock market. So how do we then eliminate the risk? So if you see here, again, this is a growth one. If you see last 20 years, this is a stock market, right? 5.24 average, right? If you look at the indexing, which is I'm going to cover, where we say we have a cap and a floor. Cap means the maximum you can make is certain percentage, and the floor means you will never have a risk. You will never have a loss. In this case, if you see this here, for example, and again, I'm rushing through this because we covered in the last session. But again, reach out to me and I'll go over this in detail. You see, there were losses in 2001 here, but if you see on this side, there are no loss. Basically, there's not a single minus here, and that's called index strategy, right? Those index strategies sits in many vehicles. That could be part of life insurance, could be part of annuity, could be part of your IRA, 401k. Those index strategy. Basically, we are saying, okay, give me the growth, but I don't want to take any risk. So there's no, this is the lowest you will go in this case. If you say that like same 20 years, we beat the stock market by 2.5%. Okay. Let me show you the worst 20 years ever. Okay. This was, and we talked about fear, right? So let me show you the fear. This is the worst fear for those who have actually studied the history 1929 to 1948, right? If you see here again, this was 4 years. This was called Great Depression. And then if you see this year where Germany invaded Poland, right? And this was a World War World War II. Sounds like three is on the way, but it's two. And then this was a nuclear bombing in Japan, and then this economic recovery where I think all the people died. So anyway, 10 out of 20 years market was down. $1 invested in anywhere became 59 cents. I mean, 20 cents in the fourth year itself, but then it started coming back and lost 40% of the assets. So none of the investment banking or compounding will work here, right? Nothing will work. I mean, 95% of the people lost jobs here, right? So forget about money here, nothing will work, right? At the same time, if I had index strategy, that secure compounding I was talking about, because remember in the compounding versus amortization, the compounding has to be secure. So I'm securing it by putting a floor. So if you see here, every time market went down, we did not go down. You see your dollar stayed at dollar. And then market went up, you start making that 13%, up to 30%. Same 20 years, that one became 288. So if this is the confidence we gain, then definitely borrow and invest, right? Okay, so we go further. As I said, I'm rushing through this one. So those who don't understand, please pardon me because this is this. So I'm gonna skim through this one also. This is something will take more time. But let me show you how the stock market works, right? So somebody invested $100, market went up 10%, you make 10%. Market went up 20, you make 20, and so on and so forth. So market went all the way 40%, 100 became 145. Market went down 40%. Now we have compounding losses also. So basically you lost. Market went up 40, market went down 40. You're not at 100, you're at 87. This is called negative compounding, which we don't want. That's the worst thing. On the right side, I'm going to put index link or that secure compounding. Again, the cap and floor. Okay. Market went up 10%, you make 10%. Market goes 20%, you will not make 20%, you'll make 13%. Right? And likewise, you make 137. Now market goes down 40% here. Your 137 will stay at 137. And that is your floor. That's your risk eliminated completely. Now pay attention on the left side. Market went up 10%. Okay, you're 87, barely broke even, 96. On the right side, 10%, 151. So what am I trying to show you? I personally purposely put a cap in the real life vehicles we have in this indexing. We do not even have caps. They are unlimited. But I'm purposely putting a cap here so I can show you a limited return on the right side. So right side is a limited return, no risk. Left side, unlimited return, unlimited risk. And look at this. In the 5 years, 6 years, the left side barely broke even though it's an uptrend. On the right side, we are 50% up. So guys, the best money we can make is the money we don't lose when the market crashes. So this is the power of compounding, but risk-free compounding. Okay. So again, this is the facts of 97 till now. The blue line is that bank CD or bonds or government bonds, right? 100,000 became 170 in like 23 years. It's not fun. It doesn't even double in our lifespan. The red line is our favorite S&P 500. This is what we end up doing when bank CDs are not giving. We all have end up not only we end up doing this by design, but we are forced to do it through our 401ks 529. If you do 401k, knowingly or unknowingly, you are actually investing into stock market. The good thing is you're not seeing every day, so you don't feel the pain. But those people who are retired and seeing it on a daily basis, a lot of pain. Anyway, 100,000 went to 151 in 2000, and then it crashed, became 93. It took 5 years to 6 years to break even, come back to 151, and then 2008 happened and crashed, and then it took 4 years to, and then again market went all the way up, and again the COVID happened, so it crashed a little bit. At the same time, the green line is that indexing line, the secure compounding line, right? When the market goes up, you go up. Now, I purposely am again putting a cap here. In reality, there's no cap. When the market crashes, you don't lose. So it grows and locks, grows and locks. Green line never goes down, period. So again, the $1 million question here, if you were given the choice to compound, which one makes more sense? Blue line, red line, or green line? Obviously, it's not a brainer. Green line, right? So when I said compounding versus amortization, think about my version of compounding is the green line. I'm not saying borrow, do HELOC, or put your, put your assets to the, loan and take all the money and then go and invest into stock market. I'm not saying invest into green line, which is a secure compound, where guaranteed. Okay, so not only that, it is also risk. Not only it's compounding. If you see the green line is almost. I'm not saying green line is big growth. It's as good as S&P 5. Many times been beating it, but just to because I'm putting very conservative approach there, it is like stock market, right? But you never lose money. Okay. Now, what if I say it's tax free also? So if you see here, some of the taxes, if these are the top tax brackets. If you see here, there was a time when the World War II happened, there was a 94% tax brackets. Okay. Again, that stayed a while until 1981. The taxes were so high. I'm not saying this will happen in future, but this has happened in the past. God knows if we get some, depending on who's the president, we may go back up. We are at the bottom of the taxes right now. You can see on the left, 2018 to 25, Donald Trump's tax cut has given us this lowest tax bracket, but they will get reset in 2026. And then we are back to up. So our taxes are going to go up naturally through this tax cut expiry. But also historically, we have seen the wars have been crazy. Whenever government needed the money, they have done this. They have no shame in doing this, right? That's why new presidents, new policies, new budget. So anyway, that's why we have to be aware of tax. So what if we eliminate the tax risk also? So now we are compounding money, we are eliminating the market risk, and we are also eliminating taxes, right? So for example, in the example again, let's say you're contributing to 50 and then you're growing it and you're distributing it, right? If given the choice, where we all would like to pay the taxes, and common answer will be, hey, we want to pay taxes here. So if you pay taxes here to 50, a million will become tax free because you already pay the taxes, right? Now again, do we have vehicles? Which vehicle will allow you to say, okay, pay tax now and never pay? Only one vehicle, which is Roth IRA. Most of you on the call don't even qualify for Roth IRA. And if you do, it's $7,000 a year. It's not fun. So, but there are other strategies. There are vehicles available which actually allows you to put 100,000, 200,000, 500,000, whatever you want into this strategy legally, not backdoor Roth IRA, or not any backdoor, foreign scheme. It is actually legally done through 7702. The tax code 7702 allows us to put the money there. Okay. So anyway, so let's see some real example. Actually, the reason we are here for. So we have 20 minutes. I'll try to keep it as much. And again, as I said, if anybody has questions, please do stop me. So let me now show you the infinite banking. So now you know amortization versus compounding. You also learned compounding should be secure, tax-free, risk-free. So now I'm going to show you some of the concepts. Okay. So let's say you guys have somebody has a real estate business, and this is actually one of my clients' illustration. So this is done through one of the vehicle called IUL. Okay, it's an Index Universal Life Insurance. Intent here is not to buy the insurance at all. Intent here is to use the positive arbitrage. Again, remember the positive arbitrage, borrow and borrow and invest, borrow. Same concept. So we need some vehicle to be able to handle. Life insurance gives you this. Life insurance gives you that platform. It's a vehicle. I'm not interested in the death benefit. I'm not here to sell the life insurance also. Okay, so for a second, if I just hide this column, then it will make more sense. Okay, so say this is the vehicle. So why we pick life insurance? Three reasons. It has index options, that index strategy, which is that grow and lock, the green line. A. B, it has a borrowing and investing capability. So I can now do infinite banking in here. And the three, it's tax free. Okay. And the fourth benefit, which not the real reason, was, oh, it has all the life insurance. Right? Okay. So if you're only buying for life insurance, I would have bought term policy here. So anyway, so as I said, so this person is a 31-year-old. He has some money. The goal is to buy houses. He's a real estate investor. Has nothing to do with anything else. And we are using infinite banking concept. I will take one purpose and show you how we can do it. So he's investing 25,000, 25,000, 25,000, 25,000, as you can see every year, right? He did it till 4th year, 4 year. And if I can write it down here on the screen. So he did it till here. And then what happened on the 4th year? He borrowed 75,000, right? He took money out from his contract, 75, and he invested into a house. He bought, say, one real estate, one house, okay, which he's renting or doing whatever, right? And this is not 75,000 is not enough, but he did the down payment and actually bought a house. Then he put 25, 25, 25 three times. Again, same 75 came back, and then he took it out. This time he bought a second house. Okay, then same 25, 25, 25. That's again same 75 invested back, and he took it out. Likewise, he keep doing it, and he did like how many? 1, 2, 3, 4, 5, 6, 7 houses. 7 houses on the side. Basically, he invested 500,000, took all the 525 or took all the 500,000 out and some change. Okay. So you can see he was parking money here for 3 years and taking out, parking money here for taking out, right? And this doesn't mean he or she or it, right, whatever, right? Everybody, like, so here it works for everyone. So technically, if you see his initial investment was 100,000 only, rest he was borrowing and putting back, borrowing and putting back, borrowing and putting back, right? Same money was rotating. Still, if you do the total 500,000 invested, 500,000 taken out. What was the benefit here? Two benefits. A, he ended up having 7 houses on the side, so allowed him to put a down payment whenever he needed. Plus, he had $1 million policy free, right? Remember, the life insurance, if dies, family will still get $1 million, right? So that's a auxiliary benefit or supplemental benefit, which I said, remember I said, this is not the reason we are doing it, but you see how it came automatic, still $1 million. And this guy is now 54, so 23 years of free life insurance, okay? Let me write this for a second. Everybody following so far? So invested in part. So we are just parking money. Okay. So investing, borrowing, investing, borrowing, same, same concept. If anybody is not following, please. Okay. Somebody asking question. Let me answer that. So is 100% of the fund will be invested in the ceiling? Question. So Chalapati, right? Chalapati. So no, it's not 100% invest in the ceiling. As I said, that was just a concept. In the real life, in the real vehicle of this vehicle which I'm showing you, there no ceiling. It's unlimited. If market makes 10, you will make 10. Market makes 20, you will make 20. In fact, if market makes 10, you will make 17 because they actually give you 70% bonus on top of that. Anyway, that's like super high steroid on a high steroid, but for all purpose, there's no ceiling. Okay, we are just showing as a demonstration. Will the
No,
dividend be
my
part of the
question
cap?
was like yeah, 13, 10, whatever is the ceiling that you put for S&P, like is like all the money, whatever, like 100K or 150K, whatever is the investment, is all the money part of the investment, or they do only like 70% of that is invested and that will be used towards the ceiling? Like suppose S&P went by 20%. And the ceiling is maybe 10%. Okay, so the is the whole 100K part of that 10? Like, do you get 110, or
Yes.
only if 70% invested, it will be 107, right? That's
So again, depending on what type of plan, like all 100%, whatever is there, will be invested with that index strategy, right? Ceiling or no ceiling is a second question. As I said, there's no ceiling, but let's say you're asking me ceiling, right? Yes, all 100, if you have 100,000 invested, you'll get 110 if market went up 10%, right? Now, remember, depending on which vehicle, right? So if, let's say if it's a life insurance, then not all 100,000, because there's some charges for the life insurance. Again, we will go into that detail, but charges in the sense, because now I have this policy has to pay, right? And again, if you see here, am I showing you the charges? Do I care about what's cash value? I'm just saying, look, I invested 500,000 and I got 500,000 back. Plus, I had 220,000 sitting in my cash and my life insurance. So yes, this actually all you will get it. All 110 will be back.
okay.
Actually, and more, because as I said, there's not even a ceiling. And will the dividend be part of the cap? Yes, it will be. There's no dividend, right? Because you're not investing into actual S&P 500. See, don't want to think like you're actually investing into S&P 500. This is linked to the S&P 500. If S&P 500 goes up, then you go up. That doesn't mean you actually bought. You're not investing inside the stock market. We are just linking our fund to the stock market. This fund is secure. If we bought this S&P 500, then what we will do when the market goes down? We lose money. We don't want to lose money, right? That's why we are just linking our assets to the stock market. When the market goes down, we are no longer participating in the market. If market goes up, we are back and we are participating. It's automatically done. It's a very advanced strategy done that way. So let me continue on this one. After how many, so Gita, after how many years he can start borrowing? He can start borrowing next year, but this was a specific example where there's a need was to get 75 every year. So we decided 75 will be much better if we did it at fourth year or fifth year, because we have 92 here cash value, so we're getting 75 back. And because he wanted 75, he could have done it earlier also, but then earlier he would get less money. So you can do it even the next year or next day also. So now let me continue this so it will make more sense. So we invested 500,000. We have taken all the money out. The game is over, right? Now I want you all to see the power of compounding here. So I'm going to remove this. Then this person is not, so you invested 500,000, you've taken 500,000, you have 200,000 still sitting out there, you can take more money. But let's say you forget about this. You'll see how it will look. This money, 200,000, continued to grow and became 800,000. And now look at 500,000 invested, 500,000 taken out, and the person retires. You will now get 130,000 every year for the rest of your life. I mean, you can keep going there. Like, even if you're 100 years, this 130 will never stop. This is called infinite, the 120. So remember, I wanted to show you all the actual real facts about the presentation. So this is infinite banking. You have invested 500,000, you've taken out all the money. Now your money, because of the positive arbitrage, is sitting there. It's growing, growing, growing. And when you're taking it out, you'll never run out. The same 500,000, not only, so if you look at 865, for example, 500,000 invested, taken out 500,000. Okay. Now, if you continue to take 130 out, 130 out, that's again, all of them are tax free. Okay. The entire, this column is tax free. Okay. So now at the end of 85, let's say he dies at 85. 500,000 invested, give all the 500,000 way back, plus additional, all of this money, 3.7 million. Plus, when he dies, he will still have 500,000 given to the wife or kids, tax free. So this is the power of infinite banking. Same
Andy.
500,000 you invest anywhere, it will not do this way unless you become your own bank. So how are we doing this? What actually is happening here? Like, you see, this sounds like too good to be true, but I'll tell you, so easy, so easy. This is the power. So what happens here, if you see here, when you are borrowing here, they're charging you 5% interest. But when the interest they're giving you back based on the stock market, remember that typically 7%. So they give you 7% and then you charge you 5%. So basically, you're becoming your own bank. It's infinite banking. Your money continues to grow even though you're taking money out. And remember, I never paid all this money back. I never paid this back. I'm not even paying the interest. I'm not even putting a single penny after that first 25, when I stopped here, I'm not putting a single penny. It is my plan is accumulating, paying the interest, accumulating, paying the interest is netting out. So if you see here at the end of my life, when I'm 85 or 95, whenever I die, I don't pay that. They will net out. Basically, they will see whatever my account value is, minus all the interest and all the money I borrowed, it is going to be positive. So this is called infinite banking. Okay. I know it's a little bit new concept, so don't worry. It's super easy. This is what now you may not be able to resonate with this example because maybe many of you are not investment. You don't buy houses like this. So let me now take it further. Like again, I have another example here. This is 37-year-old person. He's putting 50-50, like 25, and then he's taking 50 out. 50 out, and and then he took the remaining 200,000 at 65 also. This guy is a little older, invested 500,000, took out 500,000, and then he retires from 66. Immediately, he'll get 50 for the rest of his life. Again, 500,000, $2 million back, right? So it works in any type of this 50. This guy is also real estate, but he buys condos. So he likes to do this way. Now I want to show you how we can implement to other life goals. So if you guys can text it, right? Anybody here who's investing, who's contributing in 401k more than your employer match? Anybody here who is funding the college through 529 or decided that they will fund the college of their kids through cash? They'll pay through cash, or they will sell the asset, or they will take loan. If you are one of those, anybody here taking less than 30-year mortgage loan? Again, I'm not saying, oh, that's bad thing, but what is that? Like I at one time I had 15-year loan. As soon as I learned it, I'm like, started thinking, hold on, if I can do this, why am I paying so what is 15-year loan? Like, especially when I was doing it, my loan rate was like, again, so let's use current example. The current loan rate is how much? 15-year, 5%, 6%, 5%, say. And what is the return we're getting here? 7%. So why am I paying 5% loan faster where I can get 7% here? Remember, when I can borrow at 6% and invest at 6%, I get 300,000 more. So why can't I borrow it? Why can't I, instead of 5% loan 15 year, I'll keep it 30 year. I'll pay extra 1%. Let's say I'll pay 6%. I'll invest it something into this strategy, which gives me 7% guarantee. Right? So it makes sense, right? I will make more money that way. 529. What is happening in 529? So let me show you example, right? Some people know 529. So again, nothing wrong with 529. It's just because you did not knew this. We are always fed one or two strategies which benefits financial advisors, the corporate world, right? So let's say we have 5-year-old kid, and I think we covered this in the first session, so I'll just go faster. You have a 5-year-old kid or 10-year-old kid or 15-year-old, doesn't matter, it will work. So you're putting money in 529, okay? As you're putting money in 529, it's growing at say 5%, 6%, right? It'll grow that money at 18. When your kid is 18, it'll become 216. And now what will you do at this stage? This is the where you have to start thinking. You have 216 in your 529. What exactly are you going to do? You are going to take 61, say 62, 62, 62, 4 year, and you're going to give it to the college. Is it infinite banking? No, became zero. Your 529 has zero value after your kids graduate. If you're lucky that they did not get scholarship and you have to, if they got zero here, what will happen when they're getting married or when they want to buy a home or when they want to retire? Look at the 85-year-old kid. That 156 gave you 246. Yeah, you give you $90,000. Your gain was 90,000 and you did not pay taxes on that. That was the only benefit you had in 520. That's not infinite banking. That's finite. It's not even banking. It's basically you planted a seed. It became a big tree. You water every year with $12,000. It became a big tree, and then you cut the tree in 4 equal parts and you give it to the college. That is not infinite. Let me show you the infinite banking in this one. You put in 12,000, 12,000, 12,000. Same vehicle. So left side is the tax-free vehicle, 529. Right side is 7702 IUL. So 12, 12, 12, 12 you put. Now it also became 229. We don't care about this. What I care is I'm going to take 62, 62, 62, 62, like exactly like how to get on. That is also tax-free. You don't pay taxes on 62, 62. Okay, you take into 48, pay the college. You see here the cash value still has $23,000. Okay, did not become zero. As I was telling you, this was your tree. You did not cut your tree. You just gave the fruits from the tree to the college. And again, you're not putting a single penny after that. Now what happens is, as your tree blossoms again, you'll start seeing that 23,000 will start growing and growing and growing and growing. Remember that 248 you paid, it comes back here. Boom. Can I say technically that all the money you paid to the college came back? You can take the 236 and do whatever. You could have taken this money, funded your kids' marriage or business or further education, like doctors or whatever they want to become. They could have taken the money to buy home. They could have taken money, like they are going to take money. You see here, 451. This is your daughter, your son, going to get a tax-free 451 every year, retirement income for rest of their life. Again, infinite banking in 529, using the college funding. Instead of taking those 75, 75 in my earlier example, where you were taking the money out to buy houses, you're taking the money and giving to the college. Same concept. But look at how powerful this is. Look at the millions of dollars. I could have done, like, if I scroll on the right, I could have done it little. I could have gone specific. Hey, you know what? I pay the college when my daughter is 30. I will give her 75,000 so she can start her own business. Then money grows. I'll give 150 to buy house. You can do also that. Right? Same thing here, as I was saying. The money will continue to grow. That's why I say that, do it this way so your college will become free. Everything is tax free. Well, you can also convert into your retirement. Who is stopping you to take this money out? This is not 529. See, 529 is very specific. It's actually a trap. You can only take money for the college expense. On the right side, you can take money for whatever reasons you want and no taxes. And you can take it 529, you have to wait till 18. What if your daughter wants to buy or your son wants to buy a car at 70? You can't do that from 529. You can do it here. This 200,000, you can take it 17, 15,000, whatever, right? So that is 529. I think somebody typed for 401k. Let's do the 401k, okay? Let's say now you're over contributing. So what is over contribution? Let's say your employer says, I'm going to match 6%. And that matched dollar is, say, $10,000, right? And then you do 10,000, they do 10,000. That is free money. Always do that. Never leave that. We saw in the principle of wealth building, right? Let me show you this. Where is this table? You see this tax order, free money. Always take the free money. Never leave out. That is 100% return, right? So take the match. What about after the match is over? Like, a lot of people say, you know what? Government allows us to put 22,500 or 23,000 this year. We end up doing max contribution. I was doing it. I was guilty for that, right? Don't do that. I'll tell you. So for example, here, let's say 35-year-old person investing 15 over contribution, not the employer match, above and over that, right? So that's why I put 15. Is growing at 8% in the target fund as he gets older, 7 and 6 and 5 and 3. When he retires at 65, that how much he invested, 450, became $1 million. Awesome, 401k, right? I'm not putting a single minus, this is 401k. But I'm smoothing it out. So it becomes $1 million. Now you're getting retired. So how will you retire? Again, we use amortization formula here. So we will say, well, my $1 million stays invested for 20 years. How much money I'll make? You'll get 70, 70, 70 every year up to 85. And you die at 85. Your fund will become zero. Your 401k will become zero. It gave you back 1.4 million, but it's 401k. So you did not pay taxes. You have to pay taxes after taxes. And I'm assuming you're in a 22% tax bracket. Let's assume 15% just to be conservative. So let's say you're in 15% tax bracket. Every year you get 70 minus taxes, it's 60. So the net you got 1.2 million back. 450 invested, 1.2 million back. Problem, 86, it became zero. What if you're 87, 88, 89, 900, 90? This is a big problem, right? And this is not infinite again. This is finite. I have to assume 20 years. What if I live longer? What if you're 79 years old and still driving and you all have 32 teeth and you still have great, like your hair and you're like, still like you same charm you have. Then the last 10 years will be miserable. You'll be having a miserable life. And again, I live in a community where like a lot of old people. My neighbor is a scientist. She retired at 62 because that was the option given to her. She took that option. She's 70, 75, 76 now. She's working for Target now. Scientist. I mean, I thought like we call her doctor, Anyway, that doesn't mean she's a financial literate, right? What is the last 10 years will be miserable. You know that your asset, which was 1 million at one time, has deteriorated. You are never trained to see, you never in your life, you've never seen your asset going down. You always saw him going. So this will be not a good feeling. What if we do the infinite banking on that? Let's say the same thing, 7702, like we saw in college funding, you're putting 15, 15, that over contribution, take employer free match. Anything over, don't do it here, 7702. Okay, it became 1.5 million. As I said, I don't care about that money. What I care is how much can I withdraw? I can take 169, 937, say 170K, tax free. Here, this was 170,000 taxable, it's tax free. It's like Roth. Remember I said 770 tax free? It became at 85, it gave us back 3 million, plus we have some more left. So 4 million versus million, $3 million more. I joke with my friends. I said, if you sit with me for an hour, I'll show you how to make $1 million more. In this case, it's $3 million more. Not $3 million more, but happiness. Would you ever, like if you see in 86, 87, 90, 169 never stops as long as you live. Infinite. That is infinite. So if you retire at 65 and you know that 170 will never stop, would you have these miserable years? Would you have the example like my neighbor? You will not. Because no matter how old you are, this will never go to zero, which is the power of infinite. And again, we're running out of time, so quick time check. We have the same thing for mortgage strategy also. A lot of people ask me, yeah, 10-year mortgage, 15-year, what do you recommend? That requires a little bit deep dive. I do have an example here very quickly. So for example, this person, say 15-year mortgage, half a million, invested at 5%. If you have a 15-year mortgage, it will be cheaper compared to the 30-year mortgage, right? So fine, we said if you take 30-year 15-year mortgage, you will be done. Again, this is a monthly, so I have bear with me, it's a lot of rows. So at 180 month, which is 15-year, it becomes zero. And if you look at if you count the interest you pay in the 15-year, it's 235. Whereas if we take 30-year mortgage, it's going to be a little expensive, that half a point or 1 point, you're going to be paying more interest. In the 30 years, the interest is 394. So instead of taking 5.5, I recommend take 30-year loan. let it be expensive, but your monthly, instead of 4,000, you have to pay 2,000 or 3,000, right? So the remaining 1,000 you invest into that 770. So now if you see here, at 15th year, so if we take 30-year mortgage, and again, this is going to be a little complicated, so I don't expect anybody to understand. What I'm trying to say, instead of taking 15-year mortgage, paying faster, 5.5, I'm saying take 6% loan, invest the remaining, like pay 3,000 mortgage and 1,000 which you're supposed to pay, invest into your 7702. At the end of the 15th year, it will become 301,000 in your 7702 account, in your fund. At the end of the 15th year, here, look at your loan. Pay the loan if you want to pay the loan. So you can see that the total interest. So how much total interest you were paying here? 394. So how much more interest we paying? If we have 15-year loan, 235, 30-year loan, 394. I was going to pay 159,000 more. But look how much you get back. 301. Remember the positive arbitrage? So yes, you'll pay more interest of 159,000, but the net gain is going to be more. So the 301 minus 159, that's your net profit. Why percentage dollar? Really? Okay, 140. You make 142,000 more just doing this 30-year loan. Your net outflow is still 4,000, as if it's a 15-year loan, but you're investing that 1,000 extra here. So now you're $3,000 extra, $300,000 extra. You made 142 by just tweaking the mortgage, you know. So this is how all the concepts. There are so many more to go, but again, this is. I don't want to just be saying things which doesn't relate to you. So last thing I want to show you is my contact page. If you guys want to take a screenshot, whatever. So again, this is me. As I said, I'm certified financial planner, MBA. Reach out to me. This is the link. I'm going to post it also. If I can, one second. On the chat. Feel free to reach out to me. Book the appointment with me if you want. This is again free. Like, don't worry, I'm not going to charge you for this one. Neither you have to do anything. If you have a specific case, or if you have a specific, say, hey, I have this question. Should I, should I, for example, some people I've met, they said, I invest in India. What should I do about that? So if you have a specific, I've used some examples with, roundabout ages. If you have, reach out to me, I can show you if you're 40, 45, 50, whatever that is, right? Now, today we only covered 7702. Index strategy, I think somebody also asked, is it all 100% invested? And I said, it's not only 100% invested, not only you get 10%, when the market goes up, you get 110, you're going to get 175K. The market goes 10%, you're going to make 175 because you get 75% bonus on top of it. So those are like a little bit detailed. It takes another 1 hour. Reach out to me. I'll walk you through. And if you have any questions, I think Murli also has my phone number, contact. So, before we part, I'm going to unmute. Please unmute yourself. Ask me any questions you have. So at least I've answered all the questions before we leave.
So Andy, I have a first question regarding people who are investing in a 529, right? Now, what do you recommend highly for those kids? I mean, you just stop now and invest in IUL or something?
Well, don't just stop now, right? So we need to qualify for 7702. You can't just say, okay, I want to do 7. You need to qualify, right? So I can help you qualify, but I need to little bit know. So do one thing, set up a time with me. We'll spend 15 minutes to understand what if your daughter is like 17-year-old, right? So then it's too late also, or there are advanced strategies for that age also. So I need to know the age, how much you're contributing, how much balance you have, do you have other kids? So don't stop until you meet with me. That's the answer.
Okay. Okay. So 7702 is one of the bucket for them, people below 18, basically. That's what you're saying.
No. It's for everyone. even older people, like, even I am 50, even I have 7702. 7702 for everyone. What I'm saying is, don't just go and stop it because you learn from me,
Correct.
because I need to understand specific, I will tell you when to stop it also. Like,
Okay.
ideally, yes. Like, if you understand this,
Mm-hmm.
common sense says stop and do this,
Correct. Okay.
right?
Gotcha.
But before
Got
you
it.
do
Yeah.
that, meet with me. It takes extra 15 minutes, so we'll
Sure.
revalidate that. And also, depending on the age, you may have to stop sooner, right? I mean,
Mm.
I did like $50, 529. My first contribution was $50, and as soon as I learned that's how I learned. When I was looking for my daughter's education, that's when I found about this, and I said, you know what, this is really crazy. Now,
Mm.
infinite banking, again, as a concept, I said it's a lot of buzzword, a lot of wrong articles, fake, wrong information. Infinite banking is just a concept. You apply into your 529, apply into your 401k, mortgage, your investments. I have a friend who invests a lot of money in India. He uses infinite banking. He takes money every 2-3 years, invest in India. He makes ton of money in India. He figured out some formulas. You work both ways. Why don't you have to borrow? If I tell you, and Murli can also tell you, 0% loan, 0% loan. Who's going to give you 0% loan right now? We get 0% loan here. Actually, not 0%, minus 2% loan. They charge you 5% and they give you 7% back.
Mm-hmm. Okay.
Okay. Somebody's trying to. Chalapati, you had some questions? I saw you on mute.
No, I'm good.
Okay. And this is not the only vehicle. I think in the second session we also saw fixed index annuity. That's another vehicle which actually can sit. So this was investment contribution. Every month you're contributing, right? As you see on example. What about your IRAs or people change jobs and they have 401ks now, rollover? For that also you can use index strategy. That also you can use infinite banking, but that sits in the IRA or 401k. For that we can't use 7702 for that. We have to use annuity for that. Okay. And we saw
Annuity can
that.
be changed too. If they
Sorry.
have if somebody has an annuity and they can change back to 7702 or not.
No, it doesn't work this way. It works vice versa.
Okay. Right, so we'll say, okay, got you.
Yeah. You can take 7702 and convert it to annuity, but not the other way. But that's why I said, you need both also. Like, I have a ton of money sitting in my IRA. When I quit my job, I had like ton of money in my 401k. Am I going to keep my money there and hope that it will grow? Or would I make it secure compound? Remember we saw that example left and right. If I
Yes.
eliminate all the risk and I continue to get the stock market performance, isn't the best investment?
Correct.
I mean, stock market, Warren Buffett says the best investment ever. If I continue to get the same growth in the stock market, like, but don't have any risk and no taxes and all the liquidity, and those are the index strategy, and that's what I say, compound securing. And then also I want to warn and give you a disclaimer: don't go out and start borrowing money tomorrow at 6%. Okay, that's not the intent. You already what the way I look at it, you don't even have to impact your budget. Look at where your money is today going. If you look at your P&L, right, profit and loss, again, not most of you will be doing it, but if you look at your expenses, most of people are doing mortgage expense. That's the number one expense, or 2,000, 3,000. Is it 15 years, 7 year, 10 year? Is it a 7 1 arm? A lot of people right now doing those shorter arm to save that 1% interest. That's fine. I understand that interest rate might go down. Hopefully they'll go down as Pavel also mentioned 3. That's a good strategy. But think about this, right? When eventually, what if it goes up or down? So it's not a big deal. I had 7 1 arm and then luckily interest rate went down. So anyway, so mortgages, what is the second big expense? It's not expense, but it's investment. Knowing or unknowing, you're doing over contribution to your 401k. 401k, again, you're thinking it's a retirement fund, but that's still your money going into that. So that's 529. or money you putting in the cash or brokerage account so you can later on support for your kids. Same thing. Those are the same expense going out, or your IRA money. You contribute 6,000, 7,000, husband, wife both contribute 15,000. That's all money which is going out. Just read out it and it'll have millions of dollars more. As I showed, how many millions we saw more, and that can be you also. Okay. So thanks everyone. Thanks Murli for arranging this. We will have more sessions I'll share in future. Please do reach out to me, and if you're not reaching out, at least give a feedback on a WhatsApp group, or at least WhatsApp me, so I know that this is helping you. And like I said, I'll be having more sessions in future. Anybody's interested, please do let us know. I'm going to have some advanced sessions. A couple of weeks later, we're covering annuity again, but a little bit of pension annuity. It's a different type of annuity. It'll be on the 12th. I'll share the links, those who wants to join. It's for a different group I have.